Alright guys, hope everyone's having a good day so far. Today we are going to cover the lecture for Module 22. This is going to be a vocab heavy lecture, so pause the video when I get to certain points and move on so that way you can make sure to get the whole vocabulary word. We're going to take a look at the relationship between savings and investment spending, explain how financial intermediaries help investors achieve diversification, and identify the purpose of the four principal types of financial assets: stocks, bonds, loans, and bank deposits. Basically, it's the whole chart that just basically proves to you that savings equals investment spendings. We talked about this a little bit when we talked about how banks have to. Actually, we didn't talk about that, so anyway, basically know that for banks to have money to loan out to people, they get that from our savings. So the savings amount equals the investment spending. Adding government economic interaction with the rest of the world basically results in two changes, because that's in a very simplified economy with a single, where no government and no, it's just one closed economy. So once we include governments, basically have to know that governments can save too. And also that savings don't have to be spent on physical capital located in the same country. So people can borrow money and spend that borrowed money in other countries. All right. Now, savings and investment spending. So the budget surplus is the difference between tax revenue and government spending. The budget deficit is the difference between tax revenue and government spending. And the budget balance is the difference between revenue and spending. Now, basically, based on that, all right, that'll tell us how much our government is saving. So if we're in a surplus here, then we are saving positively. If we're in a deficit, we're saving negatively. Okay, so national savings is the sum of private savings, meaning by people like us, individuals, plus the budget balance. So in our case, because our government is running a deficit, all right, the national savings rate is going to be less than it should be because our government's deficit. Now, capital inflow is the net inflow of funds into a country, so that would be people from other countries moving money into United States banks and things like that. All right. Now, a household's wealth is the value of its accumulated savings. A financial asset is a paper claim that entitles the buyer to future income from the seller. All right, so that's basically like a stock is an example of financial asset. A loan is an example of financial asset from the bank's perspective. Basically, when you own a stock, or if the bank owns a loan, you're agreeing to pay the bank back over time plus interest. A fiscal asset is a claim on a tangible object that gives the owner the right to dispose of the object as he or she wishes. So owning a car outright or owning a house outright is an example of a physical asset. All right. A liability is a requirement to pay income in the future. A transaction cost are the expenses of negotiating and executing a deal. So it's like closing costs on buying a house or anything like that. Liability is just basically like when you have a loan. Financial risk is uncertainty about future outcomes that involve financial losses and gains. Now, the three tasks of a financial system. The first task is reducing transaction costs. That's the cost of making a deal. So it's lowering those closing costs and whatnot. Reducing financial risk, which is uncertainty about future outcomes that involves financial gains and losses. And providing liquid assets. Those are assets that can be quickly converted into cash, in contrast with illiquid assets, which cannot. Three tasks of a financial system. Continued. So an individual can engage in diversification by investing in several different things so that possible losses are independent events. An asset is liquid if it can be quickly converted to cash. So that's like your checking account, your savings account, right? That's liquid. Illiquid would be things like owning a car or a house, right? It's worth a lot of money, but you have to sell it first to then obtain the money. Stocks are another example of illiquid assets because you have to sell your stock, get the money, and then convert it. Now, there are four main types of financial assets: loans, bonds, stocks, and loan-backed securities. Basically, a loan is where you agree to pay someone back plus interest. That's an asset for someone because they are making that money back plus interest over time. A bond is the same thing, just to more like us loaning money to companies or banks or things like that. And stocks is where you own a percentage of ownership in the company. All right, now a loan-backed security is kind of different. I'll explain more about those when we come into class in the next class. All right, now a loan is a lending agreement between a particular lender and a particular borrower. A default occurs when a borrower fails to make payments as specified by the loan or bond contract. And a loan-backed security is an asset created by pooling individual loans and selling shares in that pool. Again, we'll go into more detail on that in the next class. Now, a financial intermediary is an institution that transforms the funds it gathers from many individuals into financial assets. So a mutual fund is a financial intermediary that creates a stock portfolio, resells shares of this portfolio to individual investors, and a pension fund is a type of mutual fund that holds assets in order to provide retirement income to its members. These are other financial intermediaries that we don't really need to know as much about. All right, and that's it. So go ahead and take the notes, write down any questions you might have, and I'll be here to answer for you in the next class.